Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are cracking open one of the most quietly dominant companies in the semiconductor universe, Texas Instruments, ticker TXN.
And I'm Lana Chen. Texas Instruments, the company most people know for graphing calculators, but that's roughly 6% of what they actually do. This is an analog semiconductor powerhouse, and right now they're in the middle of the biggest manufacturing bet in the history of the American chip industry.
$60 billion, Lana. That's not a typo. $60 billion in fab investment. We're going to unpack all of it. The numbers, the moat, what the street thinks, and whether this massive bet on manufacturing pays off. Let's get into it. So Texas Instruments, founded in 1951, headquartered in Dallas, Texas, about 33,000 employees. They sit in the semiconductor sector, specifically analog and mixed-signal integrated circuits. And here's the thing. This company has been around for 75 years because they make the chips that sit between the real world and the digital one.
That's the right way to frame it. Analog chips process real-world signals, temperature, pressure, sound, light, and convert them into something digital systems can understand. TI's analog segment generates 78% of total revenue. That's $12.16 billion in 2024. Their embedded processing segment adds another 16%, with microcontrollers, processors, and connectivity solutions.
And then the remaining 6% is the calculator business, DLP projection products, and custom semis. But make no mistake, this is an analog company through and through. They serve industrial, automotive, personal electronics, communications, and enterprise markets. Industrial and automotive alone account for over 65% of revenue.
Which is why the cyclical story matters so much. When factories and car plants are humming, TI prints money. When those end markets slow down, like they did in 2023 and 2024, it's a different picture. But we'll get to that.
Now let's talk about the man steering this ship. Haviv Ilan took over as CEO in April 2023, and he added the chairman title in January of this year. He's a 24-year TI veteran, came up through the analog business, which is the profit engine of the entire company.
He holds electrical engineering degrees from Tel Aviv University and an MBA from Northwestern Kellogg. Before TI, he worked at Butterfly, an Israeli RF chip startup. At TI, he ran embedded processing, then the analog division, then became COO in 2020 before stepping into the CEO role.
And his reputation is execution-focused. Disciplined capital allocator, deep technical fluency. He sits on the Semiconductor Industry Association board and the Business Roundtable. This is someone who understands both the engineering and the boardroom.
Under his watch, TI has accelerated the 300mm fab build-out while keeping the dividend intact. That's a real balancing act given the capex levels we're about to discuss.
All right, Lana, take us through the numbers. This is your world.
Let's start with valuation. TXN trades at $206.96 as of today, with a market cap of $174.84 billion. The trailing PE is 35.55 times earnings, and the forward PE drops to 28.98, which tells you the street expects meaningful earnings growth over the next 12 months. Price to book is 6.5 times, and the price to sales ratio is 8.26 times. The 52-week range runs from 139.95 to 231.32, so we're trading in the upper half of that range.
35 times trailing earnings for a semiconductor company. That's not cheap, but it's actually below the sector median of around 42 times. How does that square?
It squares because TI is a cyclical recovery story. The market is pricing in earnings acceleration, not peak earnings. Now let's look at income and growth. Trailing 12-month revenue is $17.26 billion with year-over-year growth of 13%. That's a meaningful rebound from the analog downturn of 2023 and 2024. Quarterly revenue tells the trajectory. Q1 2025 was $3.97 billion, Q2 2025 was $4.13 billion, Q3 2025 jumped to $4.74 billion, and Q4 2025 came in at $4.42 billion. That sequential dip in Q4 is seasonal. It happens every year. The trend is clearly up and to the right.
And on the earnings front?
Earnings per share trailing 12 months is $5.82. Gross margin is 57%, operating margin is 34.65%, and net margin is 28.28%. Those are world-class margins for an analog semiconductor company, and they're expanding as revenue scales back up. Now, the cash flow picture is where it gets really interesting. Operating cash flow over the trailing 12 months is $7.15 billion. Capital expenditures are $4.55 billion. That gives us free cash flow of $2.6 billion. Now, $2.6 billion in FCF sounds solid, but relative to TI's historical run rate, it's depressed. And it's depressed because of the massive fab investment cycle.
Right? Because they're building these fabs now so they can print cash for the next 20 years.
Exactly. And here's the good news. Management just slashed 2026 CapEx guidance to $2 to $3 billion, down from $4.5 billion. That's the peak to decline signal the market has been waiting for. As CapEx normalizes and 300mm capacity ramps, management is targeting free cash flow per share of $8 or more. That would be transformational. On the balance sheet, total debt is $14 billion. Cash and equivalents are $5.36 billion, giving us net debt of $8.64 billion. The current ratio is healthy at 3.5. Debt levels are elevated from the fab build-out, but manageable given the cash generation profile. Finally, dividends. TI pays $5.68 per share annually, good for a 2.91% yield. They've increased the dividend for 22 consecutive years. The 5-year dividend growth rate is 8.13%. However, and this is important, the payout ratio is currently near 100% of free cash flow. That's stretched, and it's a direct consequence of peak CapEx. As FCF inflects higher, that payout ratio should normalize quickly. Overall, Texas Instruments' financial health is solid, dominant margins, a 22-year dividend streak, and a clear path to FCF inflection. The near 100% payout ratio is the watch item, but it's a timing issue, not a structural one.
Let's see what the analysts are saying. TXN has 29 analysts covering it. 14 have it rated buy, 10 are at hold, and 5 rated as sell. The consensus price target is $214.77, which represents about 3.8% upside from today's price. The range runs from 125 on the low end to 260 on the high end. That's a wide spread.
3 notable calls worth flagging. Stifel's Tori Svanberg has a buy rating with a $240 target, citing the FCF inflection as the CapEx cycle peaks. Citi's Christopher Danley also rates it buy at $235, specifically calling out auto and industrial recovery upside. And Morgan Stanley's Joseph Moore is at equal weight with a $195 target. He's more cautious about near-term inventory normalization.
And the most recent earnings, Q4 2025, reported in January, TI delivered revenue of $4.42 billion, beating estimates, and EPS of $1.27, also a beat. Management guided Q1 2026 revenue of $4.32 to $4.68 billion, and notably used the phrase "end of the analog winter." That's a strong signal.
It is, and the insider activity tells a slightly different story. There were no insider buys in the last 90 days, but 6 notable sales in February. CFO Rafael Lizardi sold over 71,000 shares for $15.9 million. SVP Mark Gehry sold 23,000 shares for $5.2 million. Several other senior VPs sold as well. Combined insider selling exceeded $23 million.
That sounds alarming, but context matters here.
It does. These appear to be planned dispositions, consistent with pre-scheduled selling programs after the stock appreciated significantly from its 52-week low of 140. It's profit-taking on vested equity, not a distress signal.
All right, let's lay out the bull and bear cases. On the bull side, and there's a lot to like here. First, the auto and industrial recovery. These two end markets are 65+% of TI's revenue. A full cyclical rebound in the second half of 2026 could drive serious top-line acceleration. Second, the 300mm fab capacity ramp. Sherman SM1 is already in production, cranking out tens of millions of chips daily. Lehigh fabs in Utah are ramping. As CapEx peaks and output scales, FCF should inflect sharply. Management's target of $8 or more in free cash flow per share is the bull case catalyst. Third, AI-adjacent power management. Every AI server and every data center needs power management chips. The data center analog IC market hit $2 billion in 2025 and is heading toward $3 billion plus. TI plays here in a meaningful way. Fourth, CHIPS Act subsidies. TI has been awarded $1.6 billion in federal funding, with $1.5 billion in projected 2026 benefits. Investment tax credits boosted to 35%. That directly offsets fab construction costs. And fifth, market share gains. The 300mm cost advantage, 40% lower cost per chip, allows TI to price aggressively while maintaining margins. That's a structural advantage that compounds over time.
Now the bear case. First risk, cyclical stall. If industrial and automotive demand recovery disappoints or stalls out, TI's revenue rebound flattens and the earnings inflection gets pushed out. Second, the capex burden is enormous, over $60 billion committed to 7 fabs. Execution risk is real. Any delays or cost overruns weigh on free cash flow for years. This is a bet-the-company manufacturing strategy. Third, China exposure. Approximately 21% of TI's revenue comes from China. Domestic semiconductor capacity expansion in China and ongoing geopolitical tensions could erode market share in a critical region. Fourth, inventory overhang. TI was sitting on $4.8 billion in inventory as of late 2025, compared to just $1.9 billion in 2022. Extended inventory normalization could pressure margins and delay the recovery narrative. And fifth, the payout ratio. At nearly 100% of free cash flow, the dividend has essentially no safety margin right now. If capex runs over budget or revenue disappoints, something has to give, and cutting a 22-year dividend streak would not go over well with investors.
Now let's stack TI up against its analog and semiconductor peers. We're comparing to analog devices, ADI, Microchip Technology, MCHP, ON Semiconductor, ON, and NXP Semiconductors, NXPI.
ADI trades at 56.5 times earnings with a price to sales of 11.2 times. Their revenue growth is running at 30%, well above TXN's 13%. ADI's premium valuation reflects faster recovery and their high-performance analog leadership position. But you're paying up for that growth.
Microchip is an interesting comparison. Their PE is currently not meaningful because they're at trough earnings. Price to sales of 5.8 times. Revenue is actually declining at negative 8%. But Citi named them their top semiconductor pick for 2026 on the recovery thesis. They're diversified across microcontrollers, analog, and FPGAs.
ON Semiconductor has a PE of 170 times, which tells you how depressed their earnings are right now. Price to sales of 4.2 times with revenue declining 5%. Strong automotive exposure, but execution challenges and margin compression are weighing on the near-term outlook.
And NXP is probably the closest comp to TI. PE of 28.4 times, price to sales of 5.6, revenue growing at just 2%. Similar automotive and industrial exposure, trading at a discount to TXN on a slower growth trajectory but solid execution and capital returns.
The takeaway is that TXN at 35.6 times earnings is actually the most reasonably valued of the group relative to its margin profile and market position. You're not paying the premium you'd pay for ADI, and you're getting a much cleaner earnings picture than ON or Microchip.
Let's look at the options market. The put-to-call ratio is 0.88, which leans slightly bullish. Implied volatility percentile is at 42, meaning the options market isn't pricing in outsized moves from here.
Call open interest clusters at the 220 and 230 strikes, with 8,500 and 6,200 contracts respectively. On the put side, support is concentrated at 200 and 190, with 7,800 and 5,400 contracts. That $200 level is a key psychological support.
So traders are positioned for moderate upside with a defined floor around 200. Got it.
One caveat: options data is a snapshot, not a crystal ball. These positions reflect current sentiment, which can shift quickly on earnings or macro developments.
All right, the bottom line. Texas Instruments is a 75-year-old semiconductor franchise making a generational bet on manufacturing scale. They're investing over $60 billion to build out 300mm fab capacity that will give them a structural 40% cost advantage per chip. The analog recovery is underway, margins are world-class, and the dividend streak stretches 22 years.
The single most important number for investors to watch is free cash flow per share. Management is targeting $8 or more as capex normalizes. If they hit that target, TXN re-rates materially higher. If the recovery stalls and capex stays elevated, the payout ratio becomes the pressure point. That's the number, free cash flow per share.
And on that note, here's a quote I think captures the TI story perfectly. Warren Buffett once said, "Someone is sitting in the shade today because someone planted a tree a long time ago."
Fitting. The question for TI is whether the trees they're planting in Sherman, Texas right now will shade investors for the next 2 decades. The math says yes, but the cycles have to cooperate.
That's going to do it for episode 95 of Charged Alpha, our deep dive on Texas Instruments. If you're someone who likes digging into companies like this, you should know everything we research is powered by the same tools available at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
This is Charged Alpha, the S&P 500 stock encyclopedia.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.